This video will demonstrate the sample retirement plan in Financial Mappers. Screenshots may vary depending on which Financial Mappers product you are using. To commence, you should go to the starting position. It is most important to identify whether this is a single or joint plan. If you are planning for a couple and you do not select joint, then you will not be able to assign salaries, assets and loans to different people or nominate when an account is owned jointly. This is a retirement plan for a single person, John, who plans to work part-time for the first 5 years. For this exercise, just a single entry of $75,000 will be added for living expenses. When making your plans, it is recommended that you take the time to complete a detailed budget. To simplify the plan, most of the interest-earning funds will be held in the transaction account. This is like a checking account. However, in Financial Mappers, only income and expenses associated with home ownership, investments and superannuation are applied to this account. Any personal income and expenses are allocated to the budget. It is really important to remember this distinction when making a plan with Financial Mappers. John owns his own home without any debt. He also has a debt-free investment property. Apart from the money in the transaction account, a separate account has been set up to hold some cash reserves separate to other investments. John has investments in both shares and managed funds. When it comes to superannuation, you should enter all your accounts if you have more than one. Note that entering the data for this account is a two-step process. The first step is to enter the data for the account and then save. You then need to select which account is to receive your employer contributions and then save a second time. If you have a self-managed superannuation fund, then this will need to be added directly into the account when you create the plan. In this plan, there is also the inclusion of an annuity, and this has to be added directly into the plan. The last section is to allocate savings from salary, but as this is a retirement plan, entry here will not be necessary. If you would like a report of all the information added in the starting position, then you can generate a report here. You are now ready to create your plan, and the option New Plan from Starting Position should be selected. On the plan details, you will need to give the plan a name and select the plan type of retirement only. John is age 67 and his target retirement income is $90,000 a year. Now the plan is open, let's start at the first chevron, Plan Objectives. Here you can write your plan objectives and then set out the strategies you plan to use to achieve those objectives. There's a special space for you to record any general comment or any milestones. Setting your financial targets will most likely be more important during the savings phase of your life. However, having an idea of how much money you want to have left over at different time periods may be important for some. You may have up to 3 time periods. When getting started, you may want to keep it simple and start with a target for the first 5 or 10 years, depending on the length of your plan. Here's a tip. If you don't want to enter the targets, simply make the schedule and press Save, and then compare results, and this will give you the answers to all these periods. Using the asset allocation and statistics will give you a quick overview of the type of plan you are creating. There are 3 sets of options, but assets are most likely all you will need at this stage. When the plan is completed, you can return to see if you have achieved your targets. Now we are on the planner page. What we need to do here is to add the additional information required for each account. As this is a retirement plan, allocating how you draw down your assets will be an important part of the planning process. So let us start with the personal cash flow side of the planner page. Your salary was already completed in the starting position. Note you are not allocating any of this money earned in the first 5 years to save. One thing you may want to do is activate the means-tested pension. If you do this, then it will calculate if you are entitled to the age pension. With this plan, John has decided that for the first 6 years of retirement, he wants to have an overseas holiday costing $30,000 every second year. Thus, he is allocating $15,000 of his retirement income each year to save for this holiday. John has set aside $10,000 in a cash account and he does not intend to draw down any of these funds. John plans to reinvest the interest for the first 19 years and then deposit the interest into the transaction account thereafter. John has a share portfolio and he plans to have all the dividends paid to the transaction account to help fund his living expenses. He expects 60% of the fund will have imputation credits. John has decided to draw down the funds over the first 15 years of the plan. However, when you come to the managed fund account, he will not commence drawing down any funds until year 10 and draw the funds down over 30 years. This should leave funds in reserve if he needs to access them in the later stages of retirement. With managed funds, you can allocate the type of asset allocation, and in this case, a balanced fund has been selected. Note the different asset allocations between funds which are high growth, balanced and conservative. Dividends are going to be paid to the transaction account. It is anticipated that 20% of the funds will have imputation credits. Next on the list is superannuation. John has decided that as he gets older, he will reduce the percentage of growth assets, as these may be subject to more price fluctuations. Thus he has elected to have a high growth fund for the first 10 years, followed by a balanced fund for 15 years. The last 5 years of the plan will be conservative. John's superannuation also offers a management fee rebate for high account balances, and these have been entered. In the tab Drawdown, there are some things to take into consideration. Firstly, John is working part-time for the first 5 years and he will be entitled to employer superannuation contributions. For the program to accept these contributions, he must enter that time in the section called Transition to Retirement. When it comes to deciding how to draw down the funds, there are 3 options. The number of years for funds to last is the same as in other accounts. In this case, a percentage of funds has been selected. The third method is nominating a fixed dollar amount over different time periods. In addition, he can withdraw additional drawdown amounts. These are added to the main method of drawdown. There is a special rule for this drawdown. While all other drawdowns cannot be activated until you are in the retirement phase of the plan and you have reached your preservation age, these amounts can be withdrawn at any time. This was introduced for those who wanted to access an early release of funds during COVID. However, you need to ensure that you're entitled to take the early release of funds. Let us look at some of the graphs displayed in the superannuation account. The data view gives you even greater detail. John also has an annuity payable from a previous career, thus it is listed as an externally funded annuity. You can also purchase annuities, in which case the money is deducted from the transaction account. You need to nominate the value of the first year's payment and then the method of increase. On the second tab, you can nominate the method of taxation and tax credits if appropriate. Annuities have no resale value. In the graph of retirement accounts, the income from the annuity is listed as a subgraph. John has an investment property. Here we need to check all the tabs to see what needs to be added. Fees are for buying and selling costs of the property, and you can select either a percentage or a dollar value. With the investment return, the default rates are percentages. However, you can select to enter dollar values and the program will convert the value to a percentage. There is a special rule about rent increases. It is not based on the value of the property, but rather, once the rent in the first year has been established, the value is increased at the rate of inflation. Under the tab Building Improvements, you can include the data for calculation of building write-off. If you are planning any building improvements, then you can enter the cost of the improvement, the anticipated increase in the property value, and the amount for calculation of the base cost for building write-off. If you currently have assets being depreciated, you will need to select just one value and the average time over which these assets are to be depreciated. Capital purchases are items which cannot be written off as a recurrent expense. These are items like carpets and curtains. Note that the property is being sold in year 10 to provide more liquidity. The data view details the property sale. Once the property is sold, John needs to consider how he will reinvest those funds. In this example, he has decided to allocate some of the funds to buying a 10-year bond. He will roll over the bond for a second 10-year period. To maintain some investment in property, John has purchased a property trust, which is a form of managed fund. See how the asset allocation has been changed? The dividends will be reinvested and the funds will be drawn down over 15 years. The home is a source of wealth. It may be that during retirement you plan to release some of that wealth by downsizing. You may also be planning to make some extra income by renting a room. If you are planning any building improvements, these can be entered. The last account to review is the transaction account. In the one-off receipts, John has included an anticipated inheritance of $100,000 and he has allocated this to year 20, although the actual year is not known. When you use the one-off withdrawals, the funds are withdrawn from the transaction account and deposited into the budget. The last and most important thing to do is allocate how much of your superannuation and investments you want to spend each year. On this planning page you have access to all the information you need. The results can be in either present or future value. As you enter how much income you need for each period in the schedule, the transaction account balance will be displayed. This will demonstrate if you have sufficient funds in the account to pay the money to your budget. If the transaction account is overdrawn, you must re-evaluate how to fund the drawdown. You may need to sell real estate to give more liquidity, or you may need to transfer more funds to the transaction account. It is important that you understand each of these graphs. The first graph, the drawdown amount, is divided into three types. Income from your retirement accounts. This will include your superannuation and any annuities. The income generated from your investment income. If you don't have sufficient income from your superannuation and investments, then investment capital will need to be sold. When investment capital is sold, you are left with less capital on which to earn income. It would be great to have sufficient income from your superannuation and investments to fund your entire retirement income, but most people will need to sell down assets over their retirement. The second graph is showing from which accounts the money is to be withdrawn. In the data view, you can access more detail. Look at the managed funds where the withdrawal starts in year 10. If you need to change that information, you can do it directly here rather than returning to the managed fund account. The graph for net investments and retirement funds show the total value of these funds for each year. The last graph demonstrates when you may be entitled to the age pension. If you had any other non-means tested pensions, these would be included as well. Note that the money from pensions is not included in the retirement income. It is paid directly to the budget. This is a 30-year plan and John will be 97 at the end of the plan. Now, if he were younger, he may want to see when his investment funds will run out. What he can do is increase the length of the plan to, say, 50 years and view the results. Now we need to look at the cash flows between the transaction account, the retirement plan and the budget. In the transaction account, money is received from the funding accounts at the start of the year. The drawdown amount listed in the retirement income plan is deposited into the transaction account at the start of the year and is then transferred to the budget. In the budget, the income from the retirement plan is displayed as retirement income, investment income and investment capital. In year 10, the $20,000 withdrawn from the transaction account is displayed. In the last 5 years, the income from pensions is displayed. Note that sometimes the unallocated funds is showing an overdraft. This means you do not have sufficient funds to meet your budget expenses. If they are only small amounts, as in this case, you could ignore and adjust your budget closer to the time. If the amount is large, then you should review your plan and ensure that you have a balanced budget. It is always best to keep some money as unallocated funds. This is to meet any unexpected expenses. To rebalance your account, you can either reduce your expenses or increase the retirement income. In the first 5 years of the plan, John has increased his income by working part-time. Now the plan is completed, you can check back to see if you have achieved your financial targets. The best place to get a helicopter view of your plan is the review page. Here you can move the slider to any year and immediately see the results. Clicking on the information icons will give you even more information. The key indicator graphs are intended to let you check you have included all the elements of the plan. It is important that the transaction account is not overdrawn. If the account is overdrawn, then you will need to return to your plan and make changes. The drawdown funding lets you check that you have activated the drawdown from the accounts you want to use. Finally, the investment target graphs will display whether or not the targets have been achieved. On the report chevron, there are three main categories. The plan outcome report will demonstrate all the results of your plan in both present and future value. Here is a sample of the graphs. Assets and liabilities, income and expenses, return on investments, asset allocation in several formats, investment profile, and risk profile, which shows the percentage of growth assets. Note how over the length of the plan the percentage of growth assets is decreasing. If you are using Financial Mappers Pro or Financial Mappers Lite, you will have a fourth panel of reports created by the company providing access to the software. You also have an extra chevron called Plan Review, where these reports can be uploaded and reviewed one section at a time. Modelling tools can be used to consider different what-if scenarios. For example, what if the share market experiences a 3-year downturn? Cash flow modelling software is based on average returns. For this software, we are using the 20-year average return. Companies who have provided you with access to the software will most likely work on shorter averages, say the last 5 to 10 years. The reality is that prices move up and down around that average. With historical data, you can take a detailed look at that and see how it may affect the plan. For more details, you should read the PDF associated with this sample retirement plan.